Most people believe financial collapses punish ignorance, recklessness, or outright fraud. History tells a more uncomfortable story. In nearly every major market collapse, alongside the obvious speculators, another group also suffers heavy losses: experienced, disciplined, highly intelligent investors. These are people with advanced degrees, decades of exposure, sophisticated models, and carefully constructed portfolios. They study history, they read the data, they understand the risks. And yet, when systemic stress finally arrives, many of them fail the very test they believed they were prepared for. This raises a difficult question. If intelligence, knowledge, and access to information are not enough to protect investors during crises, what actually determines who survives financial collapses and who does not? Market history suggests that failure during collapses is rarely caused by a lack of intelligence. Instead, it emerges from hidden psychological pressures, structural incentives, and subtle forms of overconfidence that only reveal themselves under extreme conditions. In stable markets, smart strategies appear durable. During systemic stress, those same strategies can unravel far faster than expected. Financial collapses function as stress tests not only for banks and institutions, but for human judgment itself. They expose how people behave when models break, correlations shift, and uncertainty expands beyond what spreadsheets can represent. Investors who appear cautious during calm periods sometimes take catastrophic risks under stress. Others who preach discipline abandon it at precisely the wrong moment. To understand why this happens, it helps to clarify what a collapse test actually is. A collapse test is not an ordinary market decline. Corrections are a normal feature of markets. A collapse occurs when multiple assumptions fail at once, liquidity disappears, asset correlations converge, volatility spikes, and previously reliable hedges stop functioning as expected. Pricing becomes discontinuous. Diversification weakens. Decisions must be made under incomplete, rapidly changing information. Such environments have appeared repeatedly throughout history. The 1929 crash, the stagflationary shocks of the 1970s, the 1987 crash, the Asian financial crisis, the dot-com collapse, the global financial crisis of 2008, the European sovereign debt crisis, the pandemic panic of 2020, and numerous regional currency and debt collapses in between. Each episode had unique triggers, but they shared a consistent behavioral pattern. Large numbers of sophisticated participants misjudged risk simultaneously. It is tempting to assume these investors ignored warning signs. Historical records suggest something more nuanced. In many cases, warning signs were visible, debated, and documented extensively. Risk reports were written, valuations were questioned, stress scenarios were modeled. Yet portfolios remained exposed, positions stayed crowded, leverage remained elevated. The issue was not ignorance of risk, but miscalibration of how risk would actually unfold. Modern finance is built on probabilistic thinking. Investors are trained to evaluate distributions, expected returns, variance, and tail risk. But probability models depend on assumptions about how variables behave. During collapses, the structure of probability itself appears to change. Events modeled as extremely rare occur in clusters. Liquidity assumptions fail. Market participants respond collectively rather than independently. Outcomes begin to resemble synchronized behavior rather than random variation. Research in behavioral finance shows that expertise does not eliminate cognitive bias. In some cases, it amplifies it. Professionals often build strong internal narratives supported by data, increasing conviction in their positions. Conviction is useful during normal volatility. During regime shifts, it can delay adaptation. One documented pattern is model overtrust. When analytical frameworks have worked for long periods, signals that fall outside those frameworks are often underweighted. The more sophisticated the model, the more persuasive it feels. This creates a paradox where higher technical competence can slow behavioral adjustment when conditions change. Institutional incentives reinforce this effect. Many smart investors operate inside organizations that reward consistency more than flexibility. Performance is measured frequently. Risk limits are statistically defined. Career incentives often penalize deviation from consensus more than collective error. Managers may recognize rising systemic risk but hesitate to act because being early appears indistinguishable from being wrong. When collapse finally arrives, losses are shared broadly, reducing individual blame. Historical archives contain internal memos illustrating this tension. Analysts expressed concern, committees discussed vulnerabilities, yet exposure remained because timing was uncertain. In probabilistic environments, being early and being incorrect can look identical for long periods. This ambiguity complicates rational decision-making. There is also the problem of signal versus noise. Markets constantly generate warnings that do not lead to collapse. Yield curves, valuation extremes, geopolitical stress, and credit spreads fluctuate regularly. Experienced investors learn restraint. Ironically, this learned discipline can reduce responsiveness when a genuine regime shift occurs. Market structure further complicates collapse tests. Financial systems have become more interconnected and dependent on liquidity mechanisms. Derivatives, leverage, passive flows, and algorithmic execution increase efficiency during stable periods. Under stress, these same features transmit shocks rapidly. Strategies that appear uncorrelated in theory become correlated during liquidation. Hedging instruments become expensive or unavailable when needed most. This produces correlation convergence under stress. Assets that normally move independently begin moving together because participants respond to liquidity pressure rather than fundamentals. Diversification based on historical correlation matrices often describes calm periods better than crisis periods. Behavioral failure under stress is not limited to panic selling. Another failure mode is delay. Faced with ambiguity and conflicting signals, some investors freeze. Highly analytical individuals may continue searching for confirmation rather than acting on incomplete information. Decision-making research shows that increased ambiguity can slow action rather than accelerate it. Narrative lock-in also plays a role. Investors interpret data through stories. When dominant narratives form, such as permanent technological transformation or structural stability, contradictory evidence is often treated as temporary deviation. Smart investors are skilled storytellers of data. That skill can unintentionally anchor them to outdated interpretations. Importantly, these patterns do not imply simple irrationality. Many collapse failures arise from locally rational decisions made under globally flawed assumptions. Each step appears reasonable. Failure emerges from interaction effects between incentives, models, behavior, and system structure. Historical cases make this clear. Before 2008, many institutions recognized housing risk, declining underwriting standards, and rising leverage. Exposure continued because diversification appeared protective and timing was uncertain. Models struggled to capture regime change, a nationwide housing downturn combined with forced deleveraging and funding stress. When defaults clustered, protection weakened rapidly. The long-term capital management collapse followed a similar logic. Its strategies were grounded in sound theory and data. The failure arose when leverage interacted with correlation shifts and liquidity evaporation. The issue was not mathematical incompetence, but underestimation of how human behavior alters markets under fear. During the dot-com bubble, many professionals recognized valuation excess. Exposure remained because momentum could persist, and deviating from consensus carried career risk. Again, the collapse test was not about valuation knowledge, but tolerance for tracking error and professional pressure. Behavioral research helps explain why intelligent actors align with consensus. Informational cascades cause individuals to infer safety from others' actions. Rising prices validate participation. Transparency of flows compresses behavioral diversity. Crowding increases. Collapse tests punish crowded trades more severely. Risk measurement tools also contribute. Metrics such as value at risk often decline during calm periods, mechanically justifying larger positions before instability returns. These tools measure statistical visibility, not structural possibility. Liquidity assumptions form from another fault line. Assets tradable in normal markets can become illiquid under stress. Many portfolios fail not because their thesis was wrong, but because financing could not survive forced repricing. When researchers compare investors who survived collapses with those who did not, differences are often behavioral and structural. Survivors exhibit moderate sizing, stable funding, independence from crowding, and willingness to act under uncertainty. Adaptability under uncertainty differs from intelligence under certainty. Intelligence optimizes within frameworks. Adaptability questions frameworks when conditions shift. Survivors rarely predicted exact triggers. They built systems that remained functional when prediction failed. Structural humility appears repeatedly. Leverage limits that do not expand during calm periods. Funding not dependent on short-term rollover. Scenario planning that includes path disruption. These portfolios often underperform slightly in stable markets, but suffer smaller drawdowns during collapse. Time horizon alignment also matters. Investors with flexible capital are less likely to become forced sellers. Forced selling converts volatility into permanent loss. Unforced holding converts volatility into temporary valuation change. Procedural pre-commitment improves collapse performance. Predefined rules reduce emotional override. The rule may be imperfect, but it prevents escalation driven by panic or denial. Communication structure matters as well. Organizations that maintained broad information flow adjusted faster. Transparency reduced decision lag. Psychologically, collapse resilience correlates with process identity rather than outcome identity. Investors attached to being right hold positions longer. Investors attached to process revise more readily. Some survivors deliberately tolerated small losses as information costs. This preserved feedback loops and prevented hidden fragility. Avoiding all small losses often produced larger failures later. No framework guarantees success. Collapse environments punish certainty. Survival means retaining capital, liquidity, and decision capacity after the shock. Each crisis introduces new failure modes. Systems evolve faster than memory. Preparing for the last collapse is not the same as preparing for the next. This brings us back to the central insight. Smart investors fail collapse tests not because intelligence is irrelevant, but because intelligence optimizes within assumptions that can fail simultaneously. Collapse resilience emerges from behavioral, structural, and procedural design that anticipates assumption failure itself. Across decades of market history, collapses function less like exams of knowledge and more like audits of adaptability. They reveal how decision systems behave when prediction breaks, incentives conflict with caution, and collective behavior overwhelms individual models. Intelligence improves tools, structure shapes outcomes, and under extreme uncertainty, structure decides first.